right. Hello, everyone. Hello, Bruce.
Yes, good morning or good afternoon to everybody on the call.
Hope everyone is doing well from different parts in the world. We'll be waiting 1 or 2 minutes for everyone to join, and we'll be able to kick off today's session hosted by Agicap and the Financial Executives Group. Feel free to say a little hello on the chat box on the top right and where you are listening from. Nice. All right, then we're going to get started slowly. Welcome to everyone for today's webinar on acquiring cash forecasting technology. The idea is to compare in details the Swiss Army knife, the great and well-known ERP system, to special purpose systems for cash forecasting. So thank you, Bruce, who gave us this idea of an interesting topic to bring from your long-standing experience in treasury and cash flow management.
I'm glad we could do sort of a virtual handshake here between New York and France.
Exactly. So I'm Timothy. I'm speaking today out of Agicap's HQ in France. In Lyon, we are opening soon our US office and working with several dozens and hundreds of customers currently in the US with our cash management and cash forecasting solution. And Bruce, let you present yourself briefly.
Yes, I'm here in outside of New York City, and hopefully we can bring you a few interesting thoughts. Looking forward for the rest of the year.
Sounds great. So as a quick introduction of what we are going to cover today, we'll start with a poll so we can understand a little more about how you currently manage and forecast cash flow for your business. Quick introduction about our respective companies, the FECG and Agicap. Bruce will give us an interesting synthesis of insights from the Global Treasury Survey from PwC, where we have some very interesting thoughts on cash management and cash forecasting and treasury more broadly. Then we'll dive into ERP versus cash forecasting system. So what are the pros and cons of each? We'll start from the ERP perspective and then progressively discover what it means to use a special purpose system as a complement, taking the example of Agicap, including a short product demo. We'll then see what are the key success factors to implementing such systems and save a lot of time at the end for your questions on Agicap, on ERPs, on anything you may want to ask at the end of this session to ourselves or to other attendees of this webinar. So we would be very happy to start with a quick poll on your right. So next to the chat where we see a lot of hellos from a lot of people, you have access to a poll where you can vote for your current solution for cash forecasting. So we'll leave it here for a few seconds. And we start to already have some patterns that are showing up. All right. What is your analysis so far, Bruce?
Well, it's sort of to be expected. Spreadsheets are very easy to use, and I could see where people would prefer them maybe over an ERP system. But spreadsheets were really never designed to play well with each other. So the whole idea of spreadsheets is good, except if you're like any other company, you probably have too many of them. And so how do you know which spreadsheet is right or which one represents the top or the bottom when you're looking at your cash from the top down or the bottom up? And how do you really know they reconcile? Honestly, that is the beauty of an ERP system. There is a structure to it. Spreadsheets are great, but they're unstructured.
Super interesting. All right, so we see the two big alternatives to spreadsheets, ERP and special purpose systems are not so well represented. And so let's dive in today to dissect them and see actually what are the proper alternatives to spreadsheets. So I'll try to
It looks like we may have a tough time trying to convince people to give up their spreadsheets.
We'll see in the Q&A what are the feedback. So maybe we can start with a very quick introduction, Bruce, on your side and the work you've done in the past.
Sure. Well, I started off my career on the banking side, actually, working for large corporations, and over time have worked on the cash management side of banks as well as the cash management and cash forecasting side for corporations. I've done this for big companies and small companies, and as we'll see in a moment, I think all companies really have an issue with their cash management and cash forecasting. I am one of the managing partners of the Financial Executives Consulting Group, and we do treasury consulting, but we also do recruiting because we found that companies not only need consultants from time to time, but they really do need full-time management, especially companies that are really looking into the future. I mean, consultants, be honest, hiring a consultant for long periods of time is actually economically unaffordable. So we help companies sort of start up a process, and if they think they can take it over, that's great. But if they're short of talent, we can help them with that too.
Great. Thanks for the intro. On my side, I'm Timothy. I'm in charge of the US expansion for Agicap. So we'll dive a bit later into what we do. So we're a cash flow management and cash flow forecasting solution leader in Europe and in the world on the mid-market segments. We have about 7,000 clients over the world. And about 600 employees, so a product that's evolving fast to connect to your banks anywhere in the world, but also any kind of ERP accounting software. And we'll see also some other sources that we can link to have a flexible and automated cash flow forecast. So let's dive into the topic of today. Cash is king, more than ever. And we see it, Bruce, in the prime rates of Bank of America.
Yeah, I just wanted to sort of put a perspective on it. Now, obviously, prime rates may not apply to some of the companies on this call, but if you are on the smaller size, and the prime rate is important to you. But I think what it does show, when you look at the gradual increases between, let's say, now and where we were about 2 years ago, you're talking about obviously more than a 2 times increase in the cost of funds. And not only does it cost you money, but I think as you'll see that the cost of funds is always going to exceed what you can get for investing your funds. So the reason for cash forecasting, frankly, is that you don't want to be over borrowed, and you certainly don't want to be underinvested. So that sweet spot is where you want to be. And as we get into this a little bit more, we'll find out that it's actually very difficult when you have too many moving parts.
So going a bit deeper into those insights on the importance of cash forecasting, we selected the most interesting elements from PwC's Global Treasury Survey. It was led across about 400 companies across the world and 24 industries. So I'll let Bruce share his insight, because he has also been following this report for many years.
Sure. Well, again, this is a study based on cash and liquidity management. And as you can see here, the top priorities, from high to low, about what the top priorities are. And as you can see, when interest rates start to go up the way they did before, you'll find that funding and capital structures become more and more important. After all, you really can't pay your payroll with profits. And as we'll show in a minute here, I mean, profits is a very nice accounting concept. And it's very valuable, don't get me wrong. But at the end of the day, if you want to pay your employees, cash really works well. If you want to pay back your banks, cash really is a good way to do that. And the same thing if you're looking to expand, if you're going to make investments into the future, buying a company or building a new widget plant, you need to worry about whether you've got the cash on hand or the borrowing capacity to do that. So you can see here that what really makes sense for all the companies that PwC surveyed. Now you take this down one more step from, okay, that's nice funding, but how do you do that? And really the answer here has to do with cash flow forecasting. And you will find that while it's important, what I think is the more interesting part of this, okay, cash flow forecasting, number one, but look at this in terms of manual activities. You would have thought that cash flow forecasting, frankly, is not really unusual. So why is it that it's always heavily manual? What's under the hood here? And it's interesting that when you look at the next couple of activities in terms of liquidity management and external funding and so on and so forth, these are much more sort of strategic, which sort of gives you the impression that these are sort of more efficient in the way that they're handled. Now, you don't want to read too much into the survey here, but it gets you a feeling that maybe your company is overborrowed. And why is that? Well, because you can't forecast accurately or quickly, or your inability to do scenario planning. After all, the future is uncertain. So I guess borrowing is always the easiest to do. Call up your bank and say, gee, I need $20 million tomorrow. And if you have the capacity and your utilization is relatively low, the bank will say, okay, fine, we have an arrangement, and if you want it, then we'll give it to you. But in today's environment with higher interest rates, you're perhaps over borrowing. So when you get down to the CFO activities and treasury activities, they really are connected. Now, what does that tell you? What does that leave you with? Well, again, one of the top challenges, and I sort of hinted at that before, is forecasting. If it's manual, that means that there's just maybe, again, too many spreadsheets and they don't work well together. So the visibility isn't there, and you spend more time reconciling or emailing people than you do actually making decisions about what happens if you don't have enough cash. I'm not saying you shouldn't borrow, but why not use your operating cash flow, the cheapest source of funds, in a more effective manner? And again, you go down the list here and you can see that perhaps one of these reasons that your cash forecast is less than accurate is because of the sort of operational problems that you run into when you have many different legal entities, or you have too many systems. ERP systems are interesting, but in my experience, I've run into situations where you have more than one, which makes ERP sort of an oxymoron. Isn't it supposed to be enterprise-wide? Well, maybe not. So the idea here is that the challenge is what to do. If cash forecasting is important, which the survey seems to indicate, then what do we do or how do we do it? And that's what we're going to spend the rest of the session on.
Excellent. Thanks, Bruce. So indeed, if spreadsheets are not the most interesting solution and the best solution to forecast cash flow, what about ERPs? What about cash forecasting? So special purpose systems. Let's dive into the pros and cons.
Well, as we've seen from the small little poll, the spreadsheets seem to be the preferred method of forecasting. What we didn't do, because it would take too much effort and too many questions, is to figure out, well, where did that information come from? Now, all right, so you have spreadsheets, but are people just busy typing in all sorts of numbers? Maybe. Or so where do the numbers come from? And if they're coming from your ERP system, I would argue that you're sort of building in some data ambiguities, because an ERP system was really built to handle past transactions, debit something, credit something. It was built for accounting purposes. It's really the whole structure of an ERP system is around accrual accounting. Well, accrual accounting and cash forecasting are really not the same. Can you equilibrate them? Sure you can. I mean, if you have the imperial system of measurement and the metric system of measurement, do they reconcile? Of course they do. 25 millimeters to the inch. So all you have to do is convert them back and forth. But for those of you who may have realized years ago, NASA actually crashed one of their ships on the moon because conversions were not done well between the metric system and the imperial system, and they sort of ran out of space and crashed their spaceship. So accounting is quite rigid, used for tax preparations and filings and regulatory reasons. You have US GAAP or IFRS, and so you certainly need an ERP system because it is enterprise-wide. I mean, that is its strength. The trouble there is that it's really focused on transactions. I mean, every transaction has to be credited or debited according to various rules. Cash forecasting is based on assumptions, and maybe the past is a good predictor of the future, but maybe not. So if you're using your ERP system as a base of information from the past, okay, but how much weight should you put on those base transactions as opposed to what's happening in the future? What we're trying to suggest is that you really need sort of a one system like an ERP system, enterprise-wide, but it has to be based on assumptions, not necessarily accrual transactions that record history. I mean, after all, the forecast is about the future, and frankly, a P&L and an ERP system is about the past. So how do you bridge that gap? And what we like to suggest is that there are ways to do that frankly are better than a spreadsheet, if for no other reason than they're much more consolidated and coordinated.
Thank you, Bruce. Super insightful. So now that we've identified the pros, and in ERP is still critical to any business, but also the limitations, which explain why 90% of you work with spreadsheets today. Let's have a look at potential alternatives with special purpose systems that will bring cash flow visibility, not only accrual visibility, connectivity to third-party data like banks or other software, and also modeling, flexible modeling, like which is also the most valuable thing you have today in Excel. So we'll run through the example of Agicap, but we'll also save some time to cover other solutions that exist in the market. From what Bruce very clearly explained, ERPs will remain a core layer of the finance processes and companies' processes in general for high volume, low value tasks, well structured, but they need to be complemented by special purpose systems. So you don't need to work anytime you have a more specific modeling or more complex need. You don't need to open spreadsheets that will be shared across the whole company with the risk of errors associated. A few examples here of special purpose systems that can communicate on top of the ERP and that can connect with them. So for forecasting, if you look at the top, cash flow management and forecasting that we are discussing today, but you see also some nice solutions that are growing currently for FP&A, so to build for business modeling and projections more from a P&L basis, very complementary to cash forecasting solution, and they work hand in hand. At the bottom, more operational tasks, but still can remain cumbersome in many ERPs. AP process automation, spend or expense management, the bill.com or TPLT, and the likes. AR automation as well to complement the ERP to collect payments from customers. So Agicap focuses on cash management and forecasting historically, but also covers AR automation and progressively more and more AP and spend automation.
And I think this is to try to sort of put this in just a different form. You have the classic cash conversion cycle. All of these things are related. There's no one is better than another, but you do have to watch them all if you're going to really sort of financially perform. And this diagram tries to put all these different elements in perspective. You obviously have cash in. I mean, think about it. When your company is first founded, the accounting entry is debit cash, credit equity. That is the very first entry that you're going to make from an accounting standpoint. But after that, things go in a circle. You have a cash out to pay for labor, materials, and other third-party things. You have cash in when you sell something. You turn an order eventually into cash when you collect that AR, and so it goes. The real risk here is if the whole circle or cycle is too slow, you're going to end up borrowing because cash out is going to be greater than cash in within a certain time period. Well, what do you do when the liability comes due and you don't have that cash? Well, you can borrow. You can sell an investment, of course. But then you have the risk that the circle or cycle will not complete at all. Something will break. You perhaps have sold to a customer that, frankly, isn't going to pay you back. That's the whole reason that you have a credit department to begin with, to make sure that who you're selling to has the money to pay you back. But at the end of the day, what you're really worried about over time, if you were to project this circle over some period of time, is whether my net cash flows are going to be positive or negative. And frankly, if they're negative for too long a period of time, guess what? Your liabilities exceed your assets and you're out of business. So this is where the whole combination of profits and liquidity and risk sort of come into being through this cycle. And I think as Timothy was sort of suggesting in the slide before, is that you certainly want to plan for the future, which is why you have an FP&A department. But FP&A is a little bit more of a top-down form of forecasting, while cash management arguably is a little bit more of a bottoms-up activity. And yet they do have to meet in the middle. And this cycle here gives you an idea of how they should all sort of be on the same dance card, as they say.
Absolutely, and it is also a big insight I get out of this is how complex cash flow can get, how many moving parts we have, and so why specialized systems are needed to handle it. Technology solutions exist now to streamline this complexity, this cash conversion cycle in the short term and beyond. The idea is to enable treasury or controllers to communicate and streamline cash flow management across the whole organization. FP&A provides long-term top-down projections. Trade receivables and payables are available in the accounting department, in the accounting data. Procurement also will have inputs to the forecast, but sales with the CRM or business units as well. So instead of communicating through spreadsheets, emails, and trying to put together a complicated 13-week forecast that will be often out of date the minute you create it, special purpose systems like Agicap have been developed in the past years to automate and streamline those operations. So I've already presented this, and let's dive into how Agicap works. This is a high-level intro, then I show you about 10 minutes of demonstration of the product directly. Feel free to start if you have to list questions in the Q&A session as they go. We will register them on the right of the screen here. It can be about Agicap, but also other topics that we covered today in the webinar, and we'll aim to take those questions step by step at the end of the session. So the idea with a special purpose system is to achieve integrated cash forecasting. So to meet in the middle, like Bruce mentioned, between short and long-term forecasts, so to combine bottom-up and top-down approaches, and using third-party connectivity to automate the cash flow model, make it more robust. For this, so to achieve those fully customizable and flexible cash flow plans, we will use three main sources of data in Agicap. So on the left, and you have for these three shades of colors in this cash flow, 3 shades of green, 3 shades of inflow, 3 shades of outflows in red. The dark shade, what you see on the left, are the actuals, what's already been paid and that we collect straight from the bank. So we'll bring in the bank balances and the bank transactions on a daily basis to automatically update the actuals and provide the variance analysis or historical trends. Then, for short-term projections, we will connect typically to the ERP or any other accounting software. The idea is from the bottom up to retrieve daily payables and receivables with their due dates, adjusting for average payment delays of customers or average payment delays to suppliers, so for your average DSO and DPO. So this data learns from history and automatically updates your projections based on the actual invoices or even orders that are registered in the ERP. So that's the automated part that will update every day. Now for longer term projections, and we will dive just after on this, we can draw from a range of options to build longer term projections in Agicap, so beyond what's in the ERP. That can be very direct with assumptions, formulas, trends from the history, connecting also external models for payroll or CRM, for example, which is an interesting use case. But that can also be indirect using inputs typically from the FP&A team with a module for P&L to cash conversion. So not going too much in detail here, but the idea is to have a comprehensive approach to cash forecasting. So depending on the time horizon you have in your business, if you are focused on very short-term liquidity, you will use the cash positioning, looking at daily movements. Can I meet payroll? Can I meet this supplier payments based on very short-term automated data from the bank and the ERP? Here, of course, a very direct methodology. But you can at all times take a step back to the usual 13 weeks forecast, which will draw mostly from direct inputs, but that can also start leveraging more longer term assumptions from sales projections, from KPIs, for example, typically for the weeks 8 to 13, where you don't always have payables or receivables to match. Finally, The cash flow plan, the main view will be monthly or quarterly, here with the objective of having a yearly or even multi-year horizon on the liquidity, where you can pull from budget information, use the P&L to cash conversion module, so adding assumptions on payment terms and payment deadlines to your FP&A projections. So you can anticipate this challenge that Bruce is mentioning from the beginning. Are you overborrowed or underinvested? And so you can anticipate excess cash investment or reduce borrowing needs in the future. So the idea is to have the daily, weekly, and monthly visibility and to focus your usage on what matters most and use the corresponding data sources in the flexible platform. Summarizing the objective of such a solution and the objective of proper cash forecasting is to achieve cash efficiency with three main levers that also translate in three separate modules in the platform. In the short term, so with daily and weekly views, optimizing this operating cash flow, this working capital requirement, and those short-term movements to make sure we can finance the business with operating cash flow, the cheapest source of funding for your business. And in the medium long term, also playing with the borrowing costs. So we'll have a debt management module where you can register loans, their repayment schedules, and their potential variable rates over time. So you can really keep track of the debt servicing and how it could be optimized. On the other side of the equation, potentially optimizing any excess cash in the future. So the ability, based on the forecast, to get recommendations on how much cash can be invested on 1, 2, 3, 6, or 12 months horizons, based on the rates that you could obtain with your partner institutions. I'll dive briefly. I'll take a few minutes to share the platform itself. So I'll try to share my screen up, which should be visible now. Perfect. So this is the view you get in Agicap for one entity. Of course, the tool is able to handle multiple entities and to consolidate them for a group picture. And we are looking here at what we have concretely in the solution compared to the first intro I had on the slide. So we see this green and red for inflows and outflows, and those three shades of colors for actual transactions, expected transactions in the middle, and forecasted cash in and cash outs in the background with the light shade of green and light shade of red. What does it mean? So it means that overall the platform has three main objectives: automating the actuals, so you can have your live balances in the cash positioning view and daily movements easily visualized. So first objective, actuals monitoring. Second objective is supporting the forecast in the short, daily, weekly, or long term, based on payables and receivables in the ERP and based on the other sources of data we mentioned that can be combined. The third and ultimate objective of the platform is to have a decision-making tool where you can actually test scenarios to compare what will be the impact on the cash position. For example, if here in green you make this big investment, in this example of 30 million with some other associated impacts, or if you get this late AR payments, how is it going to affect your cash flow in the short term? Does it mean you need to borrow money that maybe you have excess cash that you can invest? That's the whole purpose of the platform, to optimize your cash flow. So if we dive a little deeper, for example, I could take here my cash inflow from sales in April 24. Let's take the cash inflow from Spain. Any cell I click on in Agicap will carry the information that's behind. So the shorter term we are, the more bottoms up we are. So you will see for any cell in the dashboard what has been paid already. So here you have the paid transactions on the right from the bank that gets updated and automatically allocated to the right category every day. But you can also see what is expected. So here, yes, we have 500K already in the bank for April. However, we are still waiting on 2.3 million that are sitting as receivables in the ERP with multiple invoices, each having an expected due date during this month, but not yet paid. And that's where credit control can come in, or we can have assumptions based on the average delays per client. But maybe we need to check if we need to chase clients using the cash collect module for cash collection, or if we have to postpone the expected payment dates to reflect in the forecast. This is for more the short-term perspective. Now, you will always have in the background a total forecasted amount that's more top-down, more high-level. That can be based off direct input in the platform here. So you can set up recurring projections, you can use historical data in the past, or you can create formulas in a very flexible way, just like in Excel. That would be a direct way of building your long-term projection. But as discussed, you can also leverage external sources. So Agicap will be able to connect to spreadsheets. So you can, of course, upload files, but you can more easily directly connect a SharePoint model or a Google Sheets model. An example could be payroll. You have a complex payroll projections that's updated by HR that sits in SharePoint or in Google Sheets. This could be connected to automatically update long-term payroll projections based on the connection. Another more indirect example that can work for the whole long-term projection is the P&L to cash conversion. Agicap enables to upload your P&L on an accrual basis and your projection for the coming months or years, and to add in your top-down assumptions. So for example, for the cash inflow in the US, in this example, half of the transactions are due to be paid on 90 days. The other half is due to be paid on 60 days. And if we take suppliers, 30 days for 30%, 60 days for 70%. We could also have more specific deadlines with, for example, for payroll or taxes, with a specific expected date in the month. So we position higher level number from FP&A projections as a proper cash projection in Agicap. So those rules will stay in the background in the platform and can be then loaded anytime you reforecast to update the cash forecast from a long-term perspective. So taking a step back, you have long-term projections that can be easily built with different methods depending on the business and the maturity of your systems, and a short-term view that will constantly be updated, constantly up to date, based on the bank feed and based on the feed of the ERP for payables and receivables. We'll find this data in the tab bank with all the bank transactions from multiple currencies, bank accounts, and banks across the world, and in the tab expected for all payables and receivables we may have. Finally, reporting. So you will be able to create custom dashboards to report, for example, to a private equity investor on a regular basis. Those reports can be customized and you can pick from a library. This can be exported to PDF or to Excel. So that's it for the short introduction of the platform. We have a few minutes left to talk a little more about what it means to implement a special purpose system, and also to give you a quick outlook of the ecosystem of solutions that exists. So I'll briefly go on the ecosystem, and Bruce will give some tips on how to succeed in selecting and setting up such a platform. So high level.
I'm sorry. Go ahead, Timothy.
Yeah, very high level on the ecosystem of treasury technology solutions. It's quite complex. There are a lot of solutions that differ based on what type, size of companies they address, small business, mid-sized business, or enterprise, and whether they are new with the design and the user friendliness you've seen of Agicap or other solutions that are quite recent, like you see here, rather legacy solutions, but still good solutions, like Kiriba, for example, or other players that are a bit adjacent on AP, AR, or ERP, but still sometimes suggesting some cash forecasting modules. So this is some of the solutions that we tend to see in the market. Cash Analytics or Trovata in the US are quite interesting. Then they will also differ a lot on what they actually provide. So a lot of them are treasury management solutions to handle the actuals, the payments, so really the day-to-day cash movements. Only a handful of them enable proper cash forecasting, advanced cash forecasting, like we've seen in the demo. From my understanding, it's just here an expert, an internal analysis. We've seen some similar options at solutions like Cash Analytics or Nomensha, but less advanced capabilities on the other who are focus more on the treasury and short-term cash management. Now, implementing a special purpose system, be it FP&A or cash flow, is also a high impact project that has its needs a number of requirements. What are your views, Bruce, on this before we go to the Q&A?
Sure. I think hopefully you've seen from the very high level demonstration that Timothy gave that the advantage of a special purpose system is compared to ERP system or even spreadsheets. Spreadsheets, first of all, don't have any dashboards. So if you're looking for any kind of visual data, and yes, you can create graphs, obviously, but if you have too many spreadsheets, what graph are you looking for? How do they integrate? How do you roll up or drill down to a series of spreadsheets? Very difficult to do because most spreadsheets are designed by individuals. So then you have to figure out what cell means what, comparing spreadsheet A to spreadsheet B. Now, ERP systems, frankly, have an organizational structure to them. So it certainly makes it easier to roll up or drill down. But again, you are looking at entries that, frankly, are book entries. Even in your cash accounts, you could be making adjustments. You could be making all sorts of entries that really don't answer the question of, it's 9 o'clock in the morning, where in the world my cash? Also, ERP systems updated once a month. So it's like a watch. Yeah, it's right twice a day, but is that really what you want in an era of high interest rates and volatile FX rates? You want to look at your cash, let's say daily, weekly, certainly sometime before the next 30 days roll over. And again, special purpose systems really can do that. They integrate with other systems. So they're better than spreadsheets and a little bit more, frankly, a little bit more timely than ERP system. So it just makes the argument for having a very strong, call it a cash subledger, if you will, but a very strong system that looks to what cash you have at 9 o'clock in the morning, because frankly, that's whatever your bank says it is. Even though your book balances may say one thing, cash in the bank is cash in the bank. You need to know that before you go forward. So a lot of it depends on, of course, what you want to do with your company, how you are structured. As you saw before, there are many systems out there on the enterprise level. Perhaps not all of them aren't appropriate for your company that is not as complex as a large public company. So you really need to look at your own needs, and you do have to come back to the people that you have to use these systems. I mean, at the end of the day, the system doesn't work by itself. It still needs people.
That's an excellent conclusion. Thank you, Bruce. I guess.
Well, I'm just
Yeah.
going to go back one slide. And this is, again, gets back to the whole idea of rigidity. Again, it could be a good thing and a bad thing. I mean, I think frankly, you want rigidity when you're trying to comply with the various regulatory authorities. But when you're looking into the future, which is highly flexible, changes constantly, rigidity gets in the way. Spreadsheets certainly are very flexible. Their sort of weak point is that they're too flexible. Anybody can do anything with a spreadsheet, and I'm not sure I want to base my future decisions on the company about spreadsheets that perhaps when they were combined there was an error somewhere in cell C7, but you didn't know that. You need some sort of structure. You need some ability to coordinate with other systems like the banks. The ability to, again, roll up and drill down. Spreadsheets really don't do it. So, as we sort of say here, do you want a Swiss Army knife, something that can do everything, or do you want a special purpose system that, frankly, is designed to do one thing and to do it very well?
Thank you, Bruce. And you share an important point, which is about the connectivity, the integration to other systems. So this layer, which is necessary for compliance, for tax, which is a source of data, and it will enable to answer a first question we have from the audience here, from Nathan. Thank you for asking. As Agicap, and I guess do special purpose systems in general have integrations, or do I have to import from a database? So of course we have integrations. That's the main, one of the main, and I would say base value of such systems is to properly integrate with data sources such as the banks for the actuals and the ERPs for payables, receivables, orders. You can also import from a database other types of data or more complicated structured data. It's possible, but by default, we aim to connect directly to the main data sources that are the banks and the ERP. So as we enter this Q&A session, we will answer from the questions as they come. You can really feel free to ask us anything on this wide topic, or on the platform Agicap, or on the FECG. I take a second question that is fairly linked to yours, Nathan, from Kimberly. Thank you, Kimberly, for your question. Is your system more or less compatible with certain ERP systems? What is the typical timeline of implementing alongside SAP, for instance? So that's a great question that I will try to answer quickly and simply. This question can be seen on the Q&A tab. So if you can ask questions on the Q&A tab, it's the best, but we'll also check the chat if there are some remaining here. So Agicap is compatible with all ERP systems, but you make a good point that some may be more easily connected or more quickly connected than others. For example, very simple small business ERPs like QuickBooks Online can be connected in one click. QuickBooks Online or Xero can be connected in one click. Many banks also can be connected in one click. NetSuite as well, we have a direct integration and partnership with NetSuite to connect, in the case of NetSuite, in a few clicks, so in a few minutes, to have a full connection up and running. Other systems, especially the ones that are more desktop-based, server-based, some versions of Sage, QuickBooks Enterprise, or SAP, can of course be connected, but will require some additional work where we work directly with, for example, your IT team or your SAP consultants to set up an automated file transfer between your ERP and Agicap. So meaning that automated exports are produced every day out of SAP with payables, receivables, and if you'd like other information as well, and transit through a secure server. It's called the Secure File Transfer Protocol, SFTP, to automatically retrieve every day this information from SAP or any other systems that may not have an API integration, especially when they are older systems like SAP. Then we have an interesting question from Rob Taylor. How do you define mid-market? I will give the Agicap's definition, but Bruce, how would you define the mid-market on your side?
Well, mid-market to me would be a company that would be under $500 million in sales. What I found over time in doing treasury consulting for a few years is that companies above $500 million usually have a treasury function. And the treasury function gets more specifically involved in cash management, debt management, risk management, and so on and so forth. But that doesn't mean that smaller companies don't have the same problem. But when you get to have smaller companies, they tend to have more of an accounting focus. And again, I'm not saying that's bad, but you do have to worry about not only accounting for things, but you have to worry about the future and whether you have enough, let's say, liquidity. But the problem here is that as you get into the smaller companies, and they get bound up in the accounting and the financial close, and forecasting the financial close are really separate functions. And if you spend all your time on the financial close, frankly, you're not going to have any time for forecasting, which means you end up in that over-borrowed or under-invested situation, or even overexposed if you have different currencies involved. So I just think it's something that you have to work at, even if you're a mid-market and below company.
Yeah, indeed. And so Agicap more specifically covers small to mid-sized businesses. So our current sweet spot and where Agicap makes the most value is for companies between 5-10 million of revenue to 500 million of revenue. So we're really positioning on this mid-market below 500 million, and also smaller businesses that work typically with QuickBooks or Xero. It reminds me that I didn't answer the end of your question, Kimberly. What is the typical timeline of implementing? So typically for a smaller business, smaller than 50 million of revenue, with a few banks, a few entities, QuickBooks Online or Xero or NetSuite, the timeline is extremely fast. We are looking at a few days or a few weeks, maximum 3 weeks, to have Agicap up and running, including the reports and the forecasts. For slightly larger mid-market companies, so between 100 million and 500 million, for example, using SAP, with more entities, more bank accounts, SAP, and maybe some other systems to integrate, the timeline will be slightly longer. So between, depending on the scope, between 3 to 6, 8 weeks maximum, if we're on a bigger scope with, for example, 5 to 10 users to train. So the answer is really wide, depending on the complexity of each implementation. It can range from a few days for a simple setup to a few weeks for more complicated setups. Anyway, Agicap connects very well to the bank, so you can use it from day one for your actuals.
You might even ask yourself, if you really want to figure out whether your business is sort of small, medium, or large, you might want to start by asking, how many spreadsheets does it take to run your company? And there is no right answer or wrong answer, but if you can't answer, I think that tells you a little bit something about how your company is being run and the operating risk that you run when some spreadsheet doesn't come in on time, or frankly, somebody leaves the company and no one understands the spreadsheet that they were using. So spreadsheets are good because they do allow you to sort of translate or to integrate one system to another. When you have too many spreadsheets, you're really looking at weak parts in your whole financial infrastructure. And so, again, you need something that's a little bit more integrated, a little bit more industrial strength as you get larger and larger.
Yeah. Edward is asking, like, once installed, what level of internal treasury resources will be required to manage the application? Is it simply a reallocation of existing resources? So yes, by default, it's an allocation of ongoing people working on spreadsheets today that will simply switch to Agicap to save time and accuracy on their current processes. Now it also depends what you want to get out of the platform from a broader project, operational or strategic project. Is it simply to automate current tasks that are very manual? In this case, you will need much less resources than you have today, at least on those topics. So people in the treasury or finance team can focus on more higher value add tasks. And an example for those higher value add tasks is forecasting, scenario planning, reporting to investors. And this is time, so it's time saved on the manual processes that can be reallocated to more strategic and high value tasks in the treasury team or in the finance team. So then it's really a decision that you can take at the beginning or during the implementation of what you actually want to get out of the product, from basic, straightforward automation to enhanced processes and decision making.
And this is, I think, a trap that a lot of companies fall into, even at the largest companies. They tend to look at systems as the solution. We'll just automate what we have. That's a problem. I think automating what you have means that you, frankly, are going to make your mistakes faster, which is not really a goal. I think you have to step back and go, okay, I wave my magic wand, I bring this in tomorrow. What can I do tomorrow that I can't do today at all? For a variety of reasons. This is where you have to think big and think about what you could use the system for. I mean, Agicap and obviously its competitors will allow you to do many things that you haven't done before. Scenario planning. Well, you didn't do that. Well, it's because we could never really do that. So we don't know we're going to bring Agicap in, and we're not going to use it for scenario planning because we've never done that before. So you've wasted the power of a system. So you really have to think about the outcomes more than you do the process. And frankly, today you're probably restricted by the methods and tools that you're using. And therefore, you're not focused on the outcomes. You're just focused on getting it done. Same thing with a financial close, where it takes 2 to 3 weeks to do your financial close. Maybe you want to close faster, which is a good thing. But at the same time, now that you closed faster, what are you going to do with the fact that you can make your decisions 2 weeks faster? What decisions do you want to make? Well, you never worried about that because you were bogged down in the details. So I think this is where you have to rethink your processes and think about outcomes.
Sounds good. And that's where technology solutions like Agicap also are very complementary also to consulting offerings, such as the FECG, where you, especially for mid-market or larger groups, those implementations also come with the full thinking of the baseline, what the needs are, and what you want to improve and start doing that you may not even think of today due to the limitations of existing processes. I see we have a last question I didn't answer, which is, how do you improve the modeling with the learnings from actuals versus forecast? Thank you, Nishit, for this question, which is probably the last we're going to be able to answer. So Agicap indeed provides a live view on actuals compared to forecasts with the percentage gap for each category. So then you have different actions that you can take. You can, of course, learn broadly, look at the source of the variances and analyze them to improve the forecast, I would say manually, so adjust your assumptions. Or there is also automations that can be set up. For example, if there is a gap to the forecast of 10%, you could say that for this category, Agicap has to automatically roll out this gap to the next month. So if we believe that the forecast is very strict, for example, I don't know if it's a budget or something like this, a payments you must make. If everything is not paid in the current month, then automatically roll out what has to be paid to the following period. So either through automations that can be set up in the tool or with your own analysis and adjustments. All right, I think we reached the end of this session. Thank you all for joining. Thanks a lot, Bruce, for your
Thank you.
expert insights. And we are both available for any questions you may have, and also on the Agicap side for custom demonstration for you and your business if you want to discover a little more. Thank you, everyone. Bye-bye.
Bye-bye.